Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us. Maybe you're listening on one of the 47 radio stations. Maybe you're watching us on YouTube, or maybe we're on your iPhone on iTunes. We appreciate you being with us. Well, today we're going to talk about the U.S. office market. You know, the office market has been very interesting. There's a lot going on in the office market. You know, companies are still trying to control cost, but the tenants have also been aware that recruiting and retention and culture is a big part of the success of their business. And then we have the people working at home, we have shared desks, we have a lot of things going on. We've also had increased construction costs, we've had low amounts of supply, so a lot of things going on in the U.S. office market. Well, please welcome my first guest. It's Walter Page. He's Director of U.S. Research with the CoStar Group. Walter, thanks for joining us today.
Thank you.
Well, we appreciate it, and you guys do a great job of covering the market, pretty much all sectors all across the country, Walter. We always appreciate hearing from you. And tell us, you know, how did the office market really perform? It seems like the market's gotten a little tighter in most markets around the U.S., hasn't it?
Yes, I would call 2015 probably the best year of the real estate cycle so far, and it may be the best year of the real estate cycle as a whole. For the year, we broke 100 million square feet of net absorption. This is the first time since 2007 that we've been able to do that. We actually hit 102 million square feet. Another big trend is we broke under 11% in terms of vacancies. Current vacancies are at 10.8. That's down 60 basis points from where they were a year ago. Rent growth, highest of this market cycle, reached 4.4. That's up from 3.9% a year ago. Obviously, some markets are doing significantly better than that. We had double-digit rent gains again in San Francisco and San Francisco in particular, and the market has just been doing pretty well all in all across the board.
You know, that's great news, especially for people investing in the office market and own office buildings. So to put it in perspective, how do these numbers compare to, you know, say the last 10 or 20 years? Is this really a remarkable time that we're seeing?
It's not actually that remarkable.
Okay.
This recovery has been slower than past recoveries. Part of the main reason why it's been slower is demographically we have less population growth than we had in the 1980s and 1990s and even in 2000. In particular, less population growth of working age people. So for this 100 million number, we would have broken about 140 million at its peak back in the last cycle. So we're down significantly. But the big thing is the construction's also down. So the vacancy numbers are similar to last time, but the rent growth at the peak in the last cycle was over 8% in 2007. Peak of this cycle is closer to 4.4 as we had over the past year. So significantly slower rent growth and not as much demand growth.
So we have had rent growth. So are our rents higher than they've been in the past?
Yeah, nearly every market across the country, well, except for some of the housing bust markets, have rents now that are higher than they were in the last cycle peak.
Okay. And, you know, we're talking about the market overall. So what about some of the different classes? I know some of the C properties, you know, some of the markets that we work are still struggling a little bit. What do you see for the different classes?
So we see three different trends here. One's dealing with flight to quality, nice space. We see a trend of people favoring urban locations. And then we see another trend related to the industry that drives that local economy. So let me just talk about the nice space. In terms of what we call 4- and 5-star space, which is similar to Class A, it's achieving net absorption rates that are double their fair share. Roughly 2/3 of net absorption is for this space versus 1/3 of the market stock. The other theme of urban locations, we're seeing the best rent growth, some of the tightest vacancies coming out of the CBD markets and what we call secondary business districts. So, for example, in Atlanta, that would be like the Buckhead area. In Boston, that would be Cambridge, or it could be West LA. Those markets are doing exceptionally well. And then finally, the other big trend has been, it initially started off with a tech and energy-driven economy and strong office markets, and that is increasingly shifting to other sectors of the economy. So more of the housing bust markets are now recovering, such as Chicago and Atlanta's, and even the Florida markets are doing significantly better. So all in all, we're seeing a good picture, but it's clearly a flight to quality.
Okay, and we're talking with Walter Page with CoStar about the U.S. office market. So Walter, you're talking about we're having rate increases. We have good rents now, but you're still seeing a lack of new construction and new supply. So what are we seeing for new construction? Where are we?
Okay, so new construction over the past year totaled 63 million square feet. That's a pretty good number. We currently have 128 million square feet underway, and we expect that the new construction numbers will go into the low 70 million square foot number for 2016. The construction is really concentrated. Right now, we still have 12 million square feet underway in the Houston area, and New York has 14 million square feet. There are 6 other metros that have significant construction of over 6 million square feet. Those are mainly markets like Washington, Dallas, Boston, Seattle, and San Jose. And in general, we think that the construction activity will continue to hold up, but it's not nearly as strong as it was in past cycles.
Yeah, so let's put that in perspective a little bit, Walter. You know, how does it compare to historic numbers of new construction? It seems like it's low, you know, from our point of view here.
It's less than half of what it was in prior cycles.
Well, that should keep the market pretty healthy. So what do you expect moving forward for 2016 and beyond?
So we expect the vacancy rates for the office sector to continue to decline. Actually, we think that they're going to bottom out at just around 10% in 2017. So, you know, we're at 10.8 today. So we got 2 more good years of occupancy gains. Of course, it depends on which market you're in. If you have significant construction like Houston, that market will see significant increases in vacancy. But for most markets, we expect to see a decline in vacancy over the next 2 years.
Interesting. So what would be your advice to companies then that need space or going to be needing space here in some of these markets if you expect rates to continue to climb and vacancy to decrease?
Well, as a tenant needing space, I would suggest, one, I always suggest going to higher quality space. I would suggest potentially not necessarily locking yourself into a long-term 10-year contract. I would rather do a 5-year contract, principally because our view is that there is a risk of a recession sometime in the next 5 years, and you know, following recessions, we often have reduction in rents and stuff like that, so there could be opportunities in the future for locking in. As far as an investor, I would suggest locking in and, you know, getting credit tenants now in case we do have that recession.
Okay. And I guess for developers, would you say there's opportunities, but be careful? What's your quick advice for them?
For developers, acting quickly in terms of starting construction and getting it completed. Now is the time to act. Don't wait, or else, this risk of recession or slowdown is out there, and we just don't know when that's going to happen.
Yeah. Well, that's good advice. Well, stay tuned. We're going to get more from Walter Page with CoStar. We're going to talk about the investment market. We're going to talk about cap rates and some strategies there. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.